Hi guys, welcome to Let's Talk Forex with Alison and Chris. In today's episode, we are going to be talking about an important but often overlooked subject, correlated currency pairs. So currency pair correlations show whether there is a relationship between the value of two separate Forex pairs. In this episode, we delve into what these relationships mean and how to trade them. Thanks so much for listening.
Hey, Alison.
Hey, Chris. How's it going?
Yeah, I'm all right, thanks. I'm still in London.
Nice.
The weather was lovely for a bit, but now it's turning. It's definitely becoming autumn here, so I'm glad to be getting out of here soon and back to Portugal, where it is going to be 28 degrees and sunny this week. So I'll be heading to the beach this weekend.
Amazing.
Which I'm much looking forward to. Yeah, I know. How are you doing?
Yeah, good. As I spoke about last week, we had hectic waves, and then this week we've got a lot of rain, so there's been a lot of flooding and a lot of wind today. But these weather events.
And you had Heritage Day yesterday in South Africa too.
Oh yes, we had Heritage Day. No, it actually cleared up nicely for Heritage Day, and everybody went to the beach. So it was quite fun. Yeah,
that's good. Did you eat your own body weight in grilled meat? I think this is what you do in South Africa, isn't it? No, you didn't.
No, I didn't. I must admit. But I think a lot of people did. It smelled like braais. So
I bet it did.
Yeah.
Awesome.
Anyway.
Awesome. Yeah, good. Just a note at the top here. We're going to be, as many of our listeners know, we work for FX Scouts, and we're rebranding a couple of our sites in the next few days. So FX India, which our Indian site, is going to be becoming part of the FX Scouts brand. I think that's happening today, actually, which is Tuesday the 26th. So from tomorrow, Wednesday the 27th of September, that will be part of FX Scouts. And then we're also doing the same with FX Australia, which will be becoming part of the FX Scouts brand as well. That'll be happening on Thursday the 28th.
Yeah.
So for Australian and Indian listeners, you won't have to do anything. There'll be redirects in place and everything. But just so you're aware, things might look a little bit different in the coming days. But today we're talking about quite an important subject, actually, and something that many traders don't realize how it may affect their bottom line, especially if you're opening multiple trades on different assets. And this is correlated instruments and correlated currency pairs as well, but more broadly, correlated instruments.
Yeah, and I think it's quite an important. It's very important sort of concept to understand.
Yeah.
So a correlation, I guess where we should start, is basically it can be positive or negative, and it's a positive or negative relationship between two currency pairs. And a positive correlation means that the two pairs move in the same direction, and a negative correlation means that they move in opposite directions. And this is very useful because they provide opportunities to realize a greater profit, but they can also be used to hedge your Forex positions and to reduce your risk. So if you know that a currency pair will move alongside or it might move against another currency pair, then you can either open another position to maximize your profits, or you could open a position with the negatively correlated or one that moves in the opposite direction to hedge your exposure. And you'd usually use this in situations where there might be an increase in volatility in the market. But we'll get to more examples just now.
Yeah, but it's important to realize that, if your predictions are wrong when you're trading correlated currency pairs, or if the markets move unexpectedly, as they often do, you can incur a much steeper loss if you've put a trade on two positively correlated pairs, or your hedge is going to be less effective than you anticipated if you're using negative correlated pairs. And it's important to know as well that the strength of a currency correlation depends on the time of day that you're trading, and this is to do with the trading volumes in the market for currency pairs. For example, pairs which include the US dollar are going to be more active during US market hours, so between 12 and 9 p.m. GMT. And pairs with the euro or the pound, they're going to be more active between 8 a.m. and 4 p.m. GMT, when the European and the British markets are open. So this is really important. So a lot of currency correlation has got to do with trading volume as well.
Yeah, absolutely. And to understand it, you'll have to become familiar with the correlation coefficient. And as you said, it depends also on, of course, the trading hours. So it sort of just gives you a brief indication. But the coefficient measures the correlation between different assets. So, we're talking about currency pairs at the moment. And it ranges from 1 to -1, with 1 representing a perfect positive correlation and -1 representing a perfect negative correlation. So if you ever did statistics at university, then all this would be quite familiar to you. But if you haven't, it's quite a simple concept. You've just got to sort of get your mind around it a bit. But if the coefficient value is 0, then there's no correlation between the price movements of different currency pairs.
Yeah, and it's quite complicated to figure this out yourself. So the easiest way to do this is with something called a correlation matrix. Most good brokers, they offer a correlation matrix as part of an advanced set of tools for MT4. It's very common. You'll see these tool sets are called different things by different brokers, but they're all essentially the same things. So with Pepstone, you want to be looking for something called Smart Trader Tools. If you're with Vantage, you want to be looking also at Smart Trader Tools. They call the same thing. Axie calls it the MT4 Next Gen. FP Markets called the MT4 Trader Toolbox. And with Admirals, there's something called the MT4 Supreme Edition. And these are all basically names for the same thing. They're an advanced set of tool sets for MT4. And inside them, they'll have a correlation matrix. If you're using another trading platform like CTrader, for instance, I know that you can download these as indicators. There are free correlation matrices available there as well.
Yeah.
Yeah.
So it's really worth looking at that, especially if you just want also to check on your, on the correlations. And I think they change as well, as as we were talking about with the time of the day, and an example we'll get to a bit later on cryptos and their correlations. It does change. So you will want to keep an eye on it. Yeah.
You want to keep an eye on it. And I should say with these correlation matrices that you can use with MT4, I mean, they're very customizable. So you can set the time period, you can set how long you want to look for, and you can change whichever assets you want to look at. They're very, very useful for checking this kind of stuff out.
Yeah, and really worth it. So we just want to run through some common correlations. The Euro USD and GBP USD, for example, are positively correlated pairs. So if you have an increase in one or a decrease in one, then you'll see an equal increase or decrease in the other. So the reason for this correlation is obviously the close relationship between the dollar, the euro, and the pound. These three currencies, the countries behind them, have very strong economic ties and between their economies. So you're definitely going to see movement sort of in similar directions between these currency pairs. While if you look at something like the Euro USD and the USD CHF, these two pairs are negatively correlated and very strongly negatively correlated. And so you'll often find that these pairs move in the opposite direction. And also because if you notice, the USD is the base currency in the one, but the quote currency in the other. So this would also give you a clue that, and of course, the Swiss franc and the euro are similar economies. So the negative correlation between these pairs is usually below 0.7, but it can go as low as minus 0.97. So it's good to be aware.
The Euro USD and the USD CHF is a really good example of this. I mean, they're one of the most strongly negatively correlated assets in the world because, as you pointed out there, the difference to USD being the base and the quote, and then and the tight link between Eurozone economy and the Swiss economy. So really, really good. If you want to understand this, really good place to start having a look at the Euro USD and the USD CHF. There's also commodities as well can be correlated. So it's not just currencies. This is particularly true if a country is a net exporter of a particular economy, such as crude oil or gold. The two most famous, the first is the Canadian dollar and crude oil. And this is a positive correlation. And typically an increase in the price of oil will see an increase in the value of the Canadian dollar. And this is really, you'll see this reflected in the movements of the USD CAD pair, because oil is traded in US dollars. And US dollar is, again, generally negatively correlated with the price of oil. So again, a really good correlation to keep an eye on there.
Yeah. And then if you look at gold, which is a very common hedge for many traders, it's positively correlated with the price of the Australian dollar, and especially with the AUD USD currency pair, so the Australian dollar US dollar currency pair. And also because Australia is a net exporter of gold, when the price of gold goes up, so does the AUD USD, and when gold slumps, the AUD USD also slumps. But again, as I was saying, in terms of a hedge, if traders are sort of not confident in the US dollar, they often hedge their trades with gold. So that's also another reason that occurs.
Yeah, and another interesting one actually is correlation is Bitcoin and the S&P 500 in the United States, the stock index. In the early years of Bitcoin, this was negatively correlated. Bitcoin was seen as kind of a haven from when financial markets were doing poorly. But since the pandemic, this has become very strongly correlated over the last few years, to a point where I think at the end of last year, you had a 0.7 correlation, which is incredibly high. That's up there with Euro USD, USD CHF.
Yeah.
But this is another, this is talking about how correlation can change. It's since decoupled from the start of this year, of 2023. And this is as the crypto bear market has really taken hold. And we're now seeing almost zero correlation between the S&P 500 and Bitcoin. And this is, again, to do with the crypto bear market, I think, mainly. It's something we wrote about a few weeks ago, how crypto has been having a pretty rough ride of it the last 12 months.
Yeah.
But yeah, so important to keep an eye on these correlated assets because they will change over time.
Absolutely. So then how do you trade on Forex pair correlations? Well, to trade on these correlations, you obviously want to identify which pairs have a positive or negative correlation to each other. And so if you use the Euro USD and the GBP USD, as I mentioned earlier, that are very strongly positively correlated, if you open a long position on both pairs, then you increase your profits only if you speculate in the right direction. But you could also increase your losses if your forecasts are incorrect. So it's very important that if you are going to do this, that you're aware of the risks involved. And I think we just want to make traders aware that these correlated pairs do move in the same direction. So if you sort of ignorantly open positions, in the same direction with two correlated pairs, we just want to make you aware that you could actually be putting yourself at a lot more risk than you realize.
Yeah. And so traders more commonly use correlations to hedge their risk. For example, you might take out a long position on the USD CHF to hedge losses you incur on a long position on the Euro USD. And that's, again, because these two currencies have a strong historical negative correlation. So a good example of this is, let's say you put $10 per pip on the Euro USD, but to hedge your exposure, you put $8.50, let's say, per pip on the USD CHF. And let's say both currency pairs move 10 pips. The Euro USD falls 10 pips, and that results in a minus $100 loss for you. But given the negative correlation, the USD CHF rises also a similar amount, about 10 points. But that's going to make you an $85 gain. So look, you've still made a net loss of minus $15 here. The $85 profit from your USD CHF position has meant that your net loss was not minus 100 if you had just kept the single Euro USD trade. So again, a really powerful tool for hedging, especially when you're unsure or the markets are volatile.
Yeah, exactly. Or alternatively, you could also open two opposite positions on two positively correlated pairs, like we were talking about the Euro USD and the GBP USD, and then the gains would basically offset the losses of the other. So another example is if you thought that the Euro USD and GBP USD were about to break their positive correlation, and it could be because the Bank of England is expected to alter interest rates, or there is an economic slowdown expected in the Eurozone, then you might choose to take a temporary short position on the GBP USD to offset any losses on your long Euro USD position.
Mm-hmm. And it's something that has happened recently, where we've seen this round of interest rate increases, and the central banks wondering whether to raise interest rates or to keep them steady. And so we've seen actually breaks in correlation between these pairs quite commonly over the summer. So really, really good example to use there. To sum up, so currency correlations, they can either be positive or negative. Positive correlations mean that the currency pairs will move in the same direction. Negative means that they'll tend to move in opposite directions. And correlations, whether they're positive or negative, they give you an opportunity, yes, to realize greater profit, but more importantly, to hedge your exposure. And that you should use a correlation matrix to better understand how positive and negative correlation will affect your trades, and do this before you open your trades, if you're going to be opening multiple trades. And finally, that currency can also be correlated with commodities. So don't just look to currency. I mean, as we mentioned there, the S&P 500 and Bitcoin, but also gold and oil all can be correlated.
Yeah, and do a bit of back testing. Go and check it out. It's quite interesting to look at all these patterns. It'll definitely improve your trading. That's for sure. Anyway, I think that's about it. But thanks so much for joining us today and for listening. If you have any questions, please don't hesitate to send them through to us at podcast@fxscouts.com. And
thanks, Alison.
Thanks,
Great.
Chris.
I'll speak to you then.
Speak to you then. Cheers.
Cheers then. Bye.